Welcome back my dear friends. A very good morning, good afternoon, good evening to all of you wherever you are in this part of the globe. And as you know, this is the DADM 3, which is Data Analysis and Decision Making 3 course under NPTEL MOOC series. And this total course duration is for 30 hours contact hours spread over 12 weeks, and number of lectures is 60 because each lecture is for half an hour. And as you can see from the slide, this is the 9th week. That means you have already completed 8 weeks, taken each week with 5 lectures, and after the 8 weeks you have already taken 8 assignments. So, you will in totality you will complete 12 assignments and then take the final examination. Now, if you remember, we had gone into the realm of quadratic programming and I was describing an example where there were many assumptions which I have skipped in order to make our storyline a little bit simple. That means, you have n number of stocks, what I have written I am just repeating it, or whatever the investments are, this example being in the portfolio management only, and you have the returns, average returns, that is found out using the concept of continuous compounding interest rate concepts. Those are not very important for our discussions here. Then you basically take the average return and multiply it by the corresponding total percentage of investment which you do in each every stock. So, that will be summation of Wi into Ri bar, and if you remember, this exactly matches by the linear component part, which is C, that Ct means the transpose function into x, where x is the decision variable. In our portfolio example case, Wi's are the decision variable, and the quadratic part was half of x into qx. So, I am not mentioning whether x is a transpose in the initial part, whether it is basically a vector one, a vector of values or a row of values, that which is basically a column vector or a row vector, and q is basically a matrix of size m cross m. In our example for the portfolio management, it will be n cross n. Now, I also mentioned that how you will find out the quadratic component in the portfolio management. It was in the fag end of the 43rd lecture, where you had basically the principal diagonals was basically given corresponding to the fact that you are trying to find out the quadratic component would be Wi square into sigma I squares. You add them up n number of times, and the twice of that component is coming, and you will divide by half is because the mirror images along opposite sides of the principal diagonal were basically the covariances, which was basically Wi into Wj into the value of sigma suffix ij, where sigma suffix ij, its estimated part obviously, they would be basically the covariances between the ith and the jth stock. And if I basically write those values of sigma ij for all the values of I and j from 1 to capital N, then you will have the Q matrix. So, let us basically further proceed in this direction, give you an idea and then come into the basic small simple concept of mathematics. And if you remember, I did mention before when we started the quadratic programming, the concept about differentiation and why dy dx would be 0 at the maximum and the minimum point. We know that, and what consequence, whether if it is d2y dx2 was greater than 0 or less than 0, what consequence it has and what implication it has in the scalar concept, and when it goes into the this matrix concept, we have seen the concept of a Hessian matrix. I am going to come to that within few minutes. So, this was basically the setup. You had the quadratic component part and the scalar part. So, the problems like above arise in a variety of settings, and I have given the example. Now, the gradient vector of, if it is gradient means dy dx function of a smooth function, when you have n number of such decision variables trying to find out the f of x, where x is a vector, and trying to basically take the functional form and map into a scalar point which is here. So, in that case, the delta of function of that function of dy dx of the function would be where you divide that function partial derivation. Remember that, because when you are finding out, not divide, when you find out the derivatives, it is partial derivative, because you are considering that the rate of change of that function with respect to first with x1, keeping x2 to xn, n being the number of variables as constant. In the second element, which will be the second element in the column vector, would be del f of del x2 considering x1, x3, x4 till xn is constant, and finally, the last value in the column 1 will be del f by del xn considering x2, x1 to xn minus 1 as constant. Now, if you remember, just few minutes back I mentioned about the Hessian matrix. The Hessian matrix of this first function would basically be the mapping from the n dimensional to the r dimension one, the one dimension one, where you are trying to basically find out the second derivative of these functions. So, obviously, the second derivative would be the second partial derivative of the matrix, and here it would be very simple like this. If you consider the second derivative, the corresponding principal diagonal would be del 2f del x1, the first element, the second one will be del 2f del x2, and the last element in the principal diagonal will be del 2f del xn. While the of the diagonal elements, they would basically will consider they are similar in the sense that the partial derivative of that function del 2f del x1 and then del x2 would be exactly equal to del 2f del x2 then del x1. That means, trying to basically find out the partial derivative of that function first with x1 then to x2 would give you the same values. That means, the functions would basically be smooth and they would be symmetric in the sense the partial derivative, second derivatives are same. If it is not, then obviously you would face problems. I am not going to the nitty-gritties of the mathematics. Now, coming back to the example, first let me discuss the example. So, we will consider a wealth of W, total amount of wealth. So, do not confuse this wealth with the concept of utility function wealth. Obviously, it would in the general scheme of things, if you go in depth and analyze that problem, obviously that would be falling in the realm of utility functions, where you have the linear function first would be with respect to the expected value, and then the second part with the second derivative which we were discussing, the quadratic concept would be coming from the concept of the variance of the utility function. So, we will skip that for our discussion. So, consider we have a wealth of W and we want to basically invest in n assets. N assets I have already mentioned, and we will consider the weights of these assets are given. Weights means the amount of investment I am going to do. So, out of the total amount of wealth capital W, so if it is 200, if I invest say for example 10 rupees in the first asset, it will be 10 by 200 is the weight which is W1. Similarly, if I invest 50 rupees in the second one, it will be 50 by 200 will be W2. So, obviously, it would mean that the sum of W1 to W capital N would obviously be 1. So, Wi is the weights of the proportions of the total wealth invested in the ith asset, and I is equal to 1 to n, and capital V is the variance covariance matrix which I have just mentioned few minutes back. Variance covariance matrix means the principal diagonal, I am repeating it, please bear with me. The principal diagonal are the variances and the off diagonal element are the covariances. So, V would be the variance covariance matrix of the returns of these n assets, while M we will discuss as the vector returns of the n assets. So, if you remember the vectors I was mentioning as R1 bar, R2 bar till Rn bar, and they were the best estimate corresponding to the mean values which was mu1 to mu n. So, this basically vector M is corresponds to R1 bar to R bar n, and n as I mentioned again, I am again mentioning is the number of scripts. Now, what we want to do in our problem, this is interesting. What we do want to do in our problem is that we want to restrict the returns of the total portfolio to be greater than equal to some return star value which is fixed beforehand. Let me number it, will be easier, or highlight it, which will this one. So, it is predefined by the investor. So, greater than type would basically give you some idea about the slack and the surplus which we would consider. Obviously, we would not be going through that discussion again, but if you remember that if we had only taken C into X, the linear part, then obviously it would be a linear programming problem. We could have solved it using the linear concept, and then the concept of slack and surplus and the artificial variables would have been considered. And in case if there is a predefined risk value, obviously we will want the risk value of the total portfolio to be less than equal to risk star. So, again here the concept of the slack and surplus would be added. So, our problem now, I have written both the parts, I have not given a plus sign in between, as it was trying to basically minimize half of x into q into x plus c into x, that is the quadratic part and the linear part. So, the first part is the minimization part is for the risk, which is a quadratic function, it is of the square term, which is something to do with the risk, the variance, and the second part is the return, which is basically the linear part, which is with respect to the returns. So, you will basically have some functional form corresponding to the weights and the number of stocks. In the second case, the risk would be corresponding to the weights and the variances, sorry, and the returns would be something to do with the functional form of the weights and the vector of the returns m. Now, in this case, as I mentioned, if there are a number of constraints, but one set of constraints would be greater than equal to the return star, which is fixed beforehand. Another set of constraints would be, or one constraint would be that the risk is less than equal to risk star, which is predefined, and obviously you will have the weights restricted between 0 and 1. Now, remember one thing, this 0 and 1 means that I am basically allowing all the values to be applicable between 0 and 1, which is basically the continuous case. It can be also be converted into a discrete case very simply. And finally, and very logically, the sum of the weights should be equal to 1, that is W i's for all I is equal to 1 to capital N is 1. Now, you could basically formulate the problem in this way. Rather than considering the wealth, why do not you consider, say for example, number of stocks you are going to buy. So, considering the price of the stocks and the number of stocks you will buy, that will give you the total amount of investment which you are going to do for each and every asset, and the total amount of investment which you will do in the total portfolio would be the sum of all the investment which you are going to do in each and every asset, which means I would not write, but I will just explain. Say for example, if n suffix I is the number of asset which you are going to buy for the ith stock, and if say for example, the corresponding price is s suffix I, then the amount of investment which you are going to do for the first asset would be n1 into s1. Similarly, for the second one it will be n2 into s2, so on and so forth till the last one which will be, and this n which I am using, consider it as a small n suffix capital N, which is the number of stocks you are going to buy for the nth stock, and s suffix capital N is basically the price of the nth stock, and sum of that is basically the total wealth W which you have. Here you could also have, and then this explanation is given, the total number of stocks are given, I is equal to 1 to n, T is the total time period. So, why I am bringing the total time period, I am going to come within 2 minutes, and Wi's are the weights assigned to the different stocks which are to be determined. So, the vector, which is the vector which I mentioned, that x value in the quadratic programming, that x is basically now W transpose or W, it is a row vector or a column vector depending on how you have formulated the problem. But remember that the size of V which you have, V is the variance covariance matrix, is capital N cross capital N. So, obviously, the matrix multiplication along with the column and the row vector should be applicable. Now, these are some simple variations which I have brought into the problem. As I mentioned that the total weight of each one of the stocks is between 0 and 1, it may so happen that you want to restrict the weights between some maximum value, and it has to be greater than some minimum value. So, in that case it will be W1 would be restricted by W1 minimum and W1 maximum. Similarly, for W2, W3 till W capital N. And as I have mentioned, Ri's are the random variables pertaining to the returns for the ith stock, and this RP star, which was basically the return star which we have just discussed few minutes back, is basically given by the investor himself or depending on the market conditions. The other values which are important for us to understand is, because if you remember I have brought the concept of time. Why I have brought the concept of time, I am going to come to that within few minutes. So, we will have RIT, the realization of the random variable, which is the return of that stock at the tth time, and sigma suffix I is the standard deviation corresponding to the ith stock or the ith script. Rho ij, as I mentioned, is basically the correlation coefficient existing between the ith and the jth stock or the jth script, and obviously if we have rho ij, then rho ij multiplied by sigma I multiplied by sigma j will give you the covariance of the ith and the jth one, which are the of the diagonal elements in that matrix V. Here also, if you remember, we have said that there is a risk star which is determined by the investor. So, here it is what I am writing, sigma square star suffix p, p is basically for the portfolio, is the threshold value of the portfolio variance which is given. And here another thing which is important for us to note, that in many of the cases we would be interested to find out how does the variance, standard deviation of the variance also fluctuate. I will come to that later on, but that has nothing to do with the quadratic programming concept. And A would basically be the matrix corresponding to RIT, that means for R1, which is the return for the first stock, they would be values R11. I am talking when I say 11, 12, 13, all numbers as I have already mentioned are the suffix values. So, you have R11, R12, R13 corresponding to the first stock at different time periods of 1, 2, 3, 4. The time periods can be the seconds, can be minutes, whatever it is. And B would basically be the vector corresponding to the return on the portfolios, the star values which have been fixed by the investor at different points of time, the first period, second period, third period, fourth period, based on the fact that when you are trying to basically find out the returns for the ith stock. So, at each and every moment. So, if you are trying to find out the return of the stock and as well as the return on the portfolio you want to fix up, it can be, say for example, after the end of the day trading for Monday, Tuesday, Wednesday, Thursday, Friday, then Saturday, Sunday is closed, again you start from Monday. Here also are a few other important concepts which will be important later on, we will see would be P is the PI denotes the percentage transaction cost for buying and selling. So, these are the transaction costs. So, how the transactions costs are coming, it has something to do with the concept, if you remember, the cost of trying to transport goods per unit from city 1 to city 2, that means from the warehouses to the distributors. So, when you are buying and selling stocks, that means when you are buying dollars from the bank, selling dollars from the bank, or when you go for a loan, take a loan or basically deposit money in the bank, obviously there are different interest rates. So, we are going to bring that into the picture by this concept of P. So, this PQ are all bold, which means they are vectors. So, P is the vector where PI denotes the percentage transaction cost for buying a stock, while Q corresponding to all the values of Q1 to capital Qn is which denotes the percentage transaction cost for selling the stocks. And if I have the n vectors of stock purchased, so obviously any increase and decrease in the percentage terms from W1 changes by, say for example, 0.01 percentage. So, obviously it would increase or decrease depending on whether the investment is changing from time period to time period. And here if you remember, the value of P is basically Q, the variance covariance matrix. I am repeating time and again, please bear with me. So, Q is the variance covariance matrix corresponding to the returns of all the n stocks. So, rather than immediately going into the data, I will come to the solutions later on. So, what why I have considered the RITs was basically I am taking whole time frame of readings. So, it is say for example, I am taking day wise. So, it is 1st of January 2019, 2nd of January 2019, so on and so forth. I have considered 240 days, trading days. So, I would consider that there is per week or 2 weeks I consider as a length of my time frame of consideration. I find out the return of the stocks each day for these 7 days or 15 days or 2 weeks, and then I find out the average. So, that average I am going to consider as R 1 bar, R 1 bar comma 1 for the first 7 number of days trading. So, again then I when I do the second window of averages, so it will be R 1 bar comma 2. So, R 1 basically means the first stock only, the next suffix 1, 2, 3, 4, considering that the bar values are there, they would be for the time periods. So, in general what we will do is that we will consider there are some overlaps. So, if this symbol O means the overlap. So, if I consider the time frame of length L, then again a length L later on, but there is an overlap of O. So, obviously it would mean that I am trying to basically normalize the readings in such a way that the overlap values would try to, it is not going to eliminate, but it is trying to going to decrease the fluctuations in the prices and the returns which are there. So, L is the size of the window, O is the size of the overlap, and T is the length of the time series which you have taken. So, with this let me read what we have done. We take stock prices BSE, DAX, then Dow Jones Indian Industrial Average, DAX being from Germany, Hong Kong Stock Exchange and Singapore Stock Exchange. For all the companies who are traded in the stock, that not all the companies means that is what how the index is defined. For 3 years and 1 month, that is from January 1st 2012 to January 1st 2015. So, total number of years and 1 month considering all the overlaps which are there. We took a window size of 150 days with 50. So, this length L is 150. So, what I was mentioning few minutes back, that 1 week or 2 weeks is basically a length which is 150 days. And we take our overlap which is O of 50 days of overlapping, that is 100 days of shifting window is constant. So, you take 150, shift it by 100, again take that 150, shift it by 100 and go accordingly. So, window size of 150 signifies 6 months seasonality in the time trend. So, 6 into 30 is 180, considering that so Saturday, Sunday and the holidays we will generally have 150 days. Not exactly 150, but it is an approximation. The window size of 150 signifies 6 months seasonality in the trend followed by the stocks, and the overlapping considers the effect of previous windows in the and the present window. So, there is some spillover, not the effect, but in the sense that they overlap in order to basically continue the trend whatever you have for the previous number of days. You repeat the data of 25 times and merge it together in order to start the bootstrapping. Bootstrapping concept I would not be going into details. Bootstrapping is basically you take the data and increase it proportionally in order to basically get the probability distribution as such. So, window length of 5 days and we also find out the mean for each window depending on. So, you can take 150 and the overlaps can also be changed, and we do 3 different type of bootstrap. That means, we increase on concatenate the data 500 times, 1000 and 2000 number of times to get trying to basically expand the sample and make it more nearer to the population in order to find out the sample statistics is the best replica of the population parameters which you want to find. So, once I'll before coming to the actual solution techniques. So, here if you solve this quadratic programming, considering that both of the objective functions are applicable and that is a multi-objective case. Now, remember the concept of multi-objective, we had discussed the methodologies of genetic algorithm, artificial immune system, then ant colony optimization, all these things in DADM 2. So, if you consider the simulation runs of about 200 in number. So, you want to plot the quadratic function which was the risk and the linear function which was the return. Linear function we basically plot along the y axis and quadratic function we basically plot along the x axis. So, it will give you such, if there are straight lines, there is no variation, it will give you some straight lines like this. So, what you do is that you basically go along the vertical axis, join there. So, this will give you the portfolio corresponding to a risk value of, say for example, sigma 1 square return of RP 1, and from here you will get W 1 comma 1 means for the first case, similarly W n comma 1. Then again, if I do it for blue color, can I do? Yes, and I do it for the second case. So, this is sigma 2 2, this is RP 2, this is a bar, remember. So, you have W 1 2 W n 2. You can do it accordingly. So, portfolio risks versus portfolio return are plotted for BSE, and you can find it out accordingly and do the runs as required. So, if you had only plotted the returns, then you would basically have the returns and the portfolio values. So, you were trying to basically maximize the return. So, that will give you some set of weights which would not exactly match here. Then if you find out the values of the risk only, trying to minimize in the quadratic case, you will have only the risks only, and there would be a different sets of weights corresponding to that. Now, if I want to change, so as I am traversing the graph, I am basically changing the values of RP star, which is the investor defined, and the sigma square P star. As I change the values, I slowly build up the frontier as I plotted, and for each and every point the weights are changing. If I plot the weights for each and every point, so you will basically have for all the stocks. So, these coloring schemes would be for all the stocks. So, you see the yellow one for the BSE, and the prices change, prices obviously change, which means the percent investment for each and every stock will change. So, with this I will end the 44th lecture and discuss more about the quadratic programming in the 45th lecture. Thank you very much and have a nice day.